G'day, here's the market update for May 2026. What do we want from the investments? We want a better chance of positive returns and less risk. Number one golden rule, only buy good value. What is good value? It's when the PE ratio is 15 or less, and that means there's less risk and more potential. The PE ratio now for the Australian market is 21, which is in the bad value category, way above 15. The Australian share market over the last 12 months looks like this. You can see it was going on an upward trend there, but now it's in a downward trend. Don't know how long that'll continue, but hopefully long enough for us to get some good value. We've had a change of index. We've been using the All Ordinaries index. Now we're going to use the ASX 300, basically because we can't get data that I want for the All Ordinaries anymore. And the ASX 300 is the closest. The All Ordinaries is the 500 biggest. I did a lot of comparisons on them. There's not a lot of difference. And we'll still be using a PE of 15 as the target. The value for good value is the ASX 300 is now 8,693. It'd have to drop to 6,212 thereabouts to be good value. This is the US market, really bad value. Global markets, bad value. This is the market temperature. It's cold. Over here is where you want to buy. When it's over here, that's when we want to buy. Interest rates, well, banks are still expecting interest rates to be going down in the long term, and the RBA, or the Reserve Bank of Australia, thinks that the inflation is going to drop after a year or so that should see interest rates go down as well. Earnings growth. In Australia, Australian companies, the 200 biggest companies in Australia, think that earnings are going to be 14% bigger in the coming 12 months than in the past 12 months. In the US, it's 19%, so the next 12 months is going to be 19% better than the past, and the world's 16%. That's all positive. All those companies think that earnings are going to increase. Fear factor, I'm not too worried about the market making any major changes at the moment. Looking at the risk reward ratio, this is for a portfolio with 30% in growth assets, which is shares and property, and 70% in defensive. And this is the sort of portfolio we're using at the moment. And that should deliver historically 90% of the time where we are at the moment, between 7.5 as a positive potential and -3 as a negative. So this is about 2.5 times bigger than that, and I'm quite happy with that. So my prediction, markets will go up or down or sideways. I cannot predict what markets will do, but I can say they are poor value and we want good value. In summary, Australia shares are poor value, US poor value, global shares poor value, and for a portfolio with 30% growth, 70% defensive, you can expect returns between this and this in the next 12 months. And there's a general advice warning. This information, have a good read of this. Don't take this as specific personal advice. If you're going to get advice, if you're going to do something, make sure you get a specialist investment professional who can help you with that. Okay, thank you and have a great day.